And our goal here today is so that as you're watching this, maybe you can get familiar with these terms to the point that you can have a coherent conversation with your actual bookkeeper or your tax service provider or your accountant there. Let's talk about now term number 4, equity. This is the total amount of money that has been invested in the company by its owners. If a small business is owned by one person or the group of humans, then this total should be shown in a capital account. Talk to me about why it's important to keep track of the equity of a business.
Well, the equity is a reflection of essentially the accumulated funds that have been put into business by the owner and the earnings of the entity since its inception. And it's important. It's used a lot by, the banking and the bonding industries to gauge a company's ability to take on debt. You maybe have heard the term debt to worth ratios.
Yeah.
So that it's used quite a bit, but yet it's never given much attention to by anyone. But it is an important number that appears in your balance sheet.
And if you have aspirations to grow a business from small to big, you really need to know this. You need to understand your liabilities, your equity, your assets, because again, if not, you can't get bank loans, you can't grow your business. It's really important for you to understand this. Do you find that almost every business owner, when you first sit down and look at their numbers, that their equity is wrong and their liabilities are wrong and their assets are wrong? I mean, is it usually just...
Typically, if they've had no assistance.
Okay. To
that point, right.
So don't beat yourself up if that's you. It's okay. Now we're moving on to the income statement, term number 5. This is the financial statement that provides an overall summary of a company's activity, financially speaking, over a given period of time. In your mind, what's an income statement?
Well, an income statement is a reflection of a given time period of the funds that were earned by a company, not necessarily collected. Because if you're using accrual basis accounting, which is the preferred method for management purposes, you're oftentimes allowed to use cash for tax purposes. However, accrual basis is the method of accounting that's preferred and is more reflective of the true results of operations, so that your income is the amount you've earned during the period, not what you've collected, and your expenses are those that have been likewise incurred during the period.
If I'm watching this and I have no idea what the word accrual means, can you walk me through what that word means?
Okay, accrual means you recognize events at the time the event occurs. For example, you do a job and you send an invoice to your customer. At that point in time, under accrual method, you recognize an account receivable and revenue. Whereas if you are using the cash method, you would do nothing at that point in time. When you collect your money, you would show cash and revenue.
So if you had like a balance sheet, you would record the income the moment that you sent somebody an invoice, whether you actually had the money or not.
Correct.
If it was accrual. Okay.
Right.
Now we're moving on to term number 6, revenue. This refers to all the money that has been brought in through the process of selling goods and services. In layman's terms, what is revenue?
Well, revenue are essentially the sources of ultimately cash that a business realizes from providing the goods and or services that it operates within.
So when you look at most business owners and you look at their accounting situation, what are some of the most common mistakes that business owners make as it relates to calculating their revenues?
Well, again, probably maybe the failure to record it at the time they earn it, or also to reduce it at the time. Maybe they realize it's not going to be collectible if someone doesn't pay you. I think one common pitfall I see is too much of an emphasis on revenue.
Okay.
Entrepreneurs tend to be very intense on revenue, and if revenue is well or is increasing, they think everything is fine. But the problem is if you're not making a profit on that revenue, that can be very deceiving.
So entrepreneurs tend to naturally focus more on the top line, the total revenue, and not necessarily on the bottom line they have left?
That's Seems to be the case.
What causes this psychosis that we all do? Why do entrepreneurs, why do we do this? What makes us do this in your mind?
Well, I believe it's a combination of just intensity of the business and the enjoyment of doing more business.
Yeah.
It's much more fun to make a sale than it is to decline a sale because you couldn't make a profit on the sale.
Oh.
And so entrepreneurs tend to have an inclination to do the sale, close the deal, do whatever it takes to get the job.